Hey everyone, welcome back to the Recession Resistant Real Estate Radio. I'm your host, Brandon Comp. I'm joined today by Gabe. He is the host of the Real Estate Investing Club podcast and a commercial real estate entrepreneur. He's got a focus on self-storage and industrial assets. Gabe Peterson, welcome to the show.
Brandon, thanks for having me on.
Yeah, it's a pleasure to have you. For those who don't know you, give us a little bit of context about what you're doing today and maybe reverse engineer that a little bit into how you got into what you're doing today and a little background.
Cool. Yeah. What I'm doing today, I have the podcast, Real Estate Investing Club. And then the actual investing, the actual active real estate that I do is focused mostly around self-storage and then also mobile home parks and industrial. I'm just getting into industrial, just looking at that asset class. So that's what we're doing today. How I got there. I was, typical corporate story. I was working for a management consulting company, over at, big companies here in Seattle, like Microsoft, AT&T, stuff like that. I did that the instant I got into corporate, I knew I didn't want to be there. Not that there's anything against corporate. It's just, I really didn't like the commute. I didn't like that I didn't have control over my day. I didn't have control over my direction and my ability to make money. So I knew basically when I got started, I wanted to find a different route. I knew I wanted to be an entrepreneur. I wanted to start some kind of business. It took me a few tries before I actually got to real estate. I did, an e-commerce company that worked, made money, but it was just sitting behind a computer staring at the screen all day. Didn't like that. Then I tried digital marketing. And it wasn't until I did my first flip. I think it was in 2014. I did a triplex here in Tacoma. I flipped that. Me and my buddy made like $85,000, which was the most I'd ever made at that point. So I liked, kind of got me hooked on real estate. I started doing wholesales, kind of where the intro real estate typical career where I was doing some flips, doing some wholesales. And it wasn't until 2019, I think, or 2020, maybe it was 2020, that I got onto the commercial side. That was 2-3 years ago, something like that. And I bought a mobile home park. And then, I got there just because I'd met some people and knew that commercial was the way to go. Got the mobile home park. It went really well. And then I got another mobile home park and that went really well. Really well with air quotes around it, because every deal you do is going to be hairy and there's going to be problems that arise, but we're just selling it now actually. And the return is pretty good. And then we got into self-storage. Last year I bought 5 facilities. And then we're closing on one right now. And we're just actively trying to take them down. So that's where we are. And that's where I've been.
It's really interesting. There's so many people in this space that start out doing the flips and the wholesaling. That's how we got started. And to see their transition and their evolution into something else, in my experience, and I want to hear your, opinion on this and your story, there's usually a light bulb moment when you're doing these, the wholesale and flips and you transition and pivot into something else. Did you have a light bulb moment? And if so, take us back to that moment.
Yeah, it was just, I did a few flips and I just realized that you needed a shit ton of money to do it. And like you need a ton of capital to do flips. Not that you don't need capital for commercial side, like you can, but it's much more, the raising of the capital is much more specific. And it's easier to kind of plan out. And like with flips and specifically with flips, it's just, you do need to be pretty good with construction. Like you need to know what you're doing. I did not know what I was doing. I even did some of the repairs myself. And I remember I was walking through one of my flips and with a contractor, because I was going to hire him to do something. I don't remember what it was, but he commented when we were walking through, he was like, "Who did you hire to do the flooring in your house? Because it is horrible." And I'm like, "I did that. I did the flooring." So it was, I knew that wasn't what I should be doing. And also I talked to a bunch of people in RIAs and stuff, and I understood that commercial is just scales better. And I like that it's a business. When you're doing single family, not that there you can't make flipping or wholesaling or single family rentals. They're great. It's a great business model in and of itself, and there are people who do that to a great deal of success.
Mhm.
You don't have to transition to commercial, but I thought it. I liked it. I like that it's a business. I like that you can scale it pretty easily because the properties are much bigger. And that's the direction I went.
How did you get into your first commercial deal? Tell us about that experience.
That was the mobile home park. And I met a partner here in Seattle. And he had taken a course on mobile home parks. I think it was from like Kevin Bupp or something. Is that the right name? I don't know. He took some course out there for mobile home parks. He was into it. And I just knew I was actually going into multifamily, and I knew I wanted to go into commercial. But I hadn't gone down the path yet. And so met him. He wanted to do that. And I said, hey man, let's do this. And so I jumped on the boat for mobile home parks. We started marketing off market, doing RVMs, doing mailers, and got in contact with somebody out here in Washington who, that was kind of an interesting story because he owned, it doesn't matter. I got in contact with a guy, and we negotiated seller financing, bought it for really cheap. I think it was like 650,000. No, that was the second one. The first one was like 450,000.
Mm-hmm.
He gave us seller financing with great terms. And we bought it, and turned out to work, worked out pretty well. We had to do some major repairs, but it turned out pretty well. And, and that now this is the direction I'm taking.
See, I love the self-storage asset class. Our whole thesis is recession-resistant returns backed by real assets. And so we look to pivot into these asset classes that have insulation when you have things that are going on like right now, right? You've got interest rates that are capping the prices of lots of assets. You've got rising construction costs, and it's squeezing people's margins. And so when I think of recession resistance, I think of, does money continue to flow into this asset class as you get these economic contractions, or does money flow out of here? And I love self-storage for a variety of reasons. I know during these economic contractions, people downsize, they look to cut their costs. Living is one of the biggest costs. And when you downsize and you have a lot of stuff, what do you need? You need self-storage. And so this tends to do really well long-term. What are some of the other advantages and demographics of the self-storage space that make it so attractive?
Yeah. I mean, it is recession resistant because of what you just said. People, when the economy hits, shit hits the fan, they start to downsize, they need a place for all that stuff. And they put it in self-storage. And then in good times, it also works because people buy more stuff and they put it into self-storage. And so it's a good asset class. It is run, there's a lot of multifamily, one of the most popular asset classes out there, mobile home parks, stuff like that. With those asset classes, you have somebody living on the property, and that just adds a layer of complexity to the management, to the liability, all that stuff. Self-storage is run much more like a business. People aren't living there. They're just storing their stuff there. And, it's a lot easier for me, it's a lot easier to evict somebody who is just storing their stuff versus someone who's living on a property,
not actually living in it.
Yeah. If you're not paying and all you're storing is a few beds, I have no hesitation to evict you on that one. But I mean, there's a lot of reasons I like self-storage. It's you can automate it much easier than other properties or asset classes. It can, like, my facilities, they're all out of state and I run them remotely. In fact, we have one we do have somebody on site all the time, but that's kind of a unique case when we don't need him to be on site. These facilities, they can be run 100% remote, automated if you get the right stuff in place. And there's no utilities. I mean, there are utilities, but it's not as problematic as you would have in multifamily and anything like that, because there's not as many pipes. Maybe you'll have one office. You'll have electricity to the aisle lights. but it's just not as there's not as many things that can break as in multifamily or mobile home parks or something like that. Downside is vandalism. And I know you didn't ask that, but I was just kind of going through a train of thought.
Yeah.
If the one thing that you definitely have to be wary of when you buy self-storage is the location, and if it has proper security, because that is definitely the biggest headache for self-storage is break-ins, vandalism, that stuff. It can be quite a headache. So long-winded answer to your question.
Yeah, that can be a big problem when you've got people breaking into your facility, stealing your customer stuff. How do you go about mitigating that risk? Walk us through maybe your filter process for, selecting the right facilities to either buy or build, and how do you install the right security? What have you learned so far from that?
All you really need is gate, fence, or automatic gate, fence, and then security cameras. Those are the three things you need to kind of reduce vandalism. If you don't have that, one of the properties I have out in Arkansas does not have gate or fence yet, and it's just getting ransacked. We call the cops, and they're getting to the point where they're annoyed at us calling because we call them so much. And so you got to get the gate, you got to get the automatic gate and the fence, security cameras. If you have all that, you still have problems. We did have that issue at one of our facilities in Texas. And we fixed that by we hired a company to do nightly rounds. And so they come, it's like $300 a month, super cheap. But all they do is they just drive by the property, walk it really quickly, a couple times every night during their security company. So they do this all the time. And they just walk by, and if they see somebody on premise, then they'll call the cops, and they'll have them removed. And so the gate, the fence, and the security cameras are the number one thing. And then if you still have problems, hire a company to actually go out there during the nighttime, because that's when you're going to have most of the break-ins.
Okay, so that's how you mitigate with the security. What about the area? What are some of the make it or break it moments where you're underwriting the deal and you're looking at specific areas? How do you go about qualifying whether or not an area might be good to either build a self-storage facility or take one over?
Yeah. There's tons of reports you can pull out there. Track IQ is a company. Compass, you can do Compass reports, and they'll tell you kind of like the net rentable square feet that already exist in an area. And then you can do your own market study. You can call the facilities in the area, try to figure out what occupancy they're at. If they're full, that's obviously a good sign. And yeah, in terms of like trying to mitigate the risk of vandalism when you buy a property, that is really hard. You can obviously get reports on crime in the area, property crime, that kind of stuff. It's not going to give you a full picture, but it will, kind of help you. You can call property management companies in the area, try to, get a gauge as to what kind of things they deal with, because they're the property managers of other properties, and they'll most likely have a good grasp on the type of vandalism that you'll be running into. So those are the main things that you can do.
What would you say are some of the deal killers in your opinion? When you're underwriting these, you're looking at the area and you see XYZ, what would kill a deal in your opinion? What are you seeing right now?
Self-storage is super flexible. It seems to work in most areas, even remote areas, amazingly. I have these two tiny, small, less than 100 unit self-storage facilities in the middle of nowhere in Texas, and they're full all the time. I don't know why. It's just it seems to work. But what is a problem and you need to watch out for is if the area is super overbuilt. So I don't know when it was, probably in like the 80s or 90s, people just started building shit ton of self-storage facilities. And a lot of in Texas specifically, there's a lot of areas that are overbuilt, and the net rentable square feet is super high. So you got to watch out for the area being overbuilt. Any metro that has a negative net migration, I will not go into. It doesn't mean that it's going to be a bad deal. You can find good deals in shrinking areas, but it's just not something I will do. And then if the economy is shrinking as well. In fact, there's a Hot Springs, actually, in Arkansas. That's where I own one of the facilities. It has a positive net migration, but the economy is actually shrinking, and
Hmm.
that's not a good thing. So I want a positive. The economy is growing, and I want the population to be growing. That's pretty much it.
Okay, and then real quick for our audience who is interested in this, do you have any like resources or websites that you track on a monthly, weekly, quarterly, or annual basis that gives you that data?
I mean, there's tons of places out there you can get, get demographic data. The easiest one's probably bestplaces.net or .com. I think it's .net actually. It's just, you can find it for anything. Whenever I do want to do a quick gauge as to a specific metro, if it's good or not, I'll just go to
Mhm.
best places and it'll give you the net migration, the economy, all that kind of stuff.
Yeah, so probably not doing a whole lot in like Detroit, Michigan right now.
No, no, not that. I mean, there's plenty of good stuff in Detroit too. I'm not telling people not to buy in an area, but I would not buy in that area.
Yeah, yeah, someone's gonna get left holding the bag when everybody moves out. I want to
Mhm.
talk about the underwriting. There's a lot of great methods you can use to mitigate risk in your deals with self-storage. And, you and I were talking about one before we hopped on here, which was seller financing. There's so many reasons why I love seller financing, one of which, it's not a bank loan. And as you know, in every single bank loan that you have, they can call that note due, right? It's very rare that it happens, but they can do it. And what I love about seller financing is you dictate the terms and you don't have that risk of somebody potentially pulling the sheets out from underneath you. Walk us through what the advantages are, how this seller finance model works, and what the advantages are.
Yeah, man, I love seller financing. It's good for both the buyer and the seller. I've been on both sides of the table. In fact, I'm selling one of my properties right now with seller financing. It there's so many reasons why it's good. And top of mind is just it makes it easy for both parties.
Yeah.
Having to deal with banks is just a nightmare. Like they can
Yeah.
be very difficult to deal with. But with seller financing, it's you and another buyer. You guys can draw up the documents, do everything that you need to, make it really easy. And like you said, with seller financing, you can dictate the terms, and so you can really make it work for both parties. This property I'm selling in right now, the buyer is buying it for a price that generally would not work, but I'm giving him good terms, and so I'm giving him, he has to put 10% down, which is really low. And then he does interest only payments, and so he doesn't have to pay principal, which makes the monthly payment much lower. And so it's interest only, 10% down, and then there's a balloon with an option to extend if he doesn't if he isn't able to get financing at an interest rate that's lower than what he's getting at today. So you can be really creative. You can make it work for both parties. If you as a seller really want to get a certain price, you can make the terms work for the buyer. Maybe if the buyer wants terms, you can just work it to make both parties happy. And that's what seller financing is so good.
Yeah, it's a win-win for everybody, including the investors. And I'm sure you also work with investors. Tell us a little bit about how you're structuring these deals. And I've got a follow-up question after that.
Structuring the deals in terms of,
Yeah, with Invac, how would that work if an investor was interested in, getting into a self-storage deal? How would that capital stack work?
so generally if we do, if we raise capital, we're usually not doing seller financing, because if we do seller financing, we usually negotiate for low amounts down that we can just
Mhm.
buy it ourselves, and we don't need external capital. But if the seller really does not want to allow seller financing, then we'll raise capital, and that's usually 35% down is what we'll do. But at that point, 75 or what is that, 65% loan to value. And so we'll do 65% bank loan. And then the remainder will be the seller finance debt. Or sorry, will be what we raise with the passive investors. And we usually guarantee, or not guarantee, we we give them an IRR that we're shooting for. And then
Yeah.
once they hit that IRR, then we cash them out.
Yeah. Nothing's guaranteed in this
Yeah.
business. You got to be careful with that
should
word.
not have said guaranteed.
Never had any issues in the past, but I still can't guarantee anything.
Mm-hmm.
So where do you see, well, instead of this, where have you seen the space historically? And then where do you feel like it's going? What does the future look like based on your experience with self-storage?
For self-storage, yeah. I mean, I don't have a crystal ball. Numbers look good. I mean, I actually just went to a conference or more like a meetup recently about self-storage for a big player here in Washington.
Mhm.
And they did demonstrate, they had all the slides and everything, and the numbers were good. Rental rates were up, occupancy was up. They're across their entire portfolio, and they have like millions of square feet across their I think it was like 94.8 or something like that percent occupancy, which is really high. And so it seems strong right now. You never know. Things can always change, but right now it's looking strong for self-storage.
Yeah, I remember somebody telling me a year ago, and he remembers when the cap rates were like 12, 13% in the self-storage and the mobile home parks. Obviously, cap rates have compressed a ton, and nobody saw that coming, but it's pretty incredible just to see how the demand, even at these lower cap rates, is still just so strong for this type of asset class. And I think it's a testament to how well it's done historically and been able to weather all types of economic cycles. If you were a passive, have you invested passively in these deals yourself, or are you mostly doing like GP stuff?
I have not. No, I've only been on the GP side.
How would you advise somebody who wanted to be a passive investor in these types of deals to vet these deals? What are some of the red flags that you should look at? And we can probably look at this through a lens of how you would go about vetting a sponsor of someone who's bringing you a self-storage deal, and what you would do to vet the actual deal itself. Because in my opinion, that's the two biggest things I see that you really need to understand if you're doing passive income investments. It's the sponsor, the operator, and the investment itself. So anything you want to speak to there?
Yeah. I mean, yeah, I think those are the two. You hit the nail on the head. Those are the two things you need to kind of be looking at. In terms of the sponsor, just look for their track record. That's the easiest way to go about doing that. Have they done deals in the past? What were their returns? Obviously get on a call with them and try to understand, what their team's like, what their structure's like. And it doesn't sound very scientific, but a vibe check for me makes a big difference. If I can talk to the person and they sound, they have a good plan in place, they sound like they know what they're doing, they have a track record, then I have much more confidence in their ability versus if I got on the phone with them and they just sound shifty. They don't sound like they're super confident. So talk with them in person, make sure you understand them, make sure they have a track record. And then for the deal itself, I've never been an LP, but if I were to invest in a deal, I'd probably want to. The first thing I'd want to do is look at the metro, because I want to make sure that the metro is good. And so I'd look at demographic data. Is it a growing area? Just like I said with my own deals, is it growing? Mm-hmm. Is the economy growing? And then I would probably want to see the P&L that they have, that the property that they're buying. Mm-hmm. I'd want to see, that it has been performing. I mean, honestly, I'd want to go through my own due diligence process for the property if I were to put my money into a property. I'm sure a lot of GPs out there don't want to give out all that information, but but I'm super anal when it comes to underwriting properties. I want to see the nitty gritty. I want to really understand it and have confidence that it's going to be performing well.
Yeah. Now you want to cover all your bases at a high level, and I know that you can get super granular on this because when you're underwriting these commercial deals, there's like 108 plus data points that you got to look at. And it takes so long. It's so different than underwriting single family asset where you're like, okay, what are we buying the land for? What's the rehab or the construction, and what's the sales price? Okay. All right. We've got a pretty good idea, and, at least the back of the napkin math, whether or not this is something worth taking a further look in. What at a high level, what does that due diligence process look like? I know you've touched based on this a little bit with the area and the growth and the economy, but maybe get a little bit more granular if you can.
So like when I'm underwriting a property,
Yeah, you said your due diligence process. If you were to invest as a passive investor, you'd want to do your own due diligence process, and that doesn't necessarily mean that the GP is going to give up all this information. But if they did, in a perfect world, what would you want to look at?
So I mean, there's the area and then the property. So you'd want to obviously vet the area, just like we already talked about the growth, the crime data, the household data, like how many households are within the area, what's the projected growth for the area, how many housing starts are there, how many self-storage starts, so you can look to see how many self-storage facilities are actually under, have already been permitted or on the process of being built, to see how many additional square feet are coming in the area. And then I'd want to look at the property. I'd want to understand, see all the reports, the occupancy reports, the P&Ls, understand how it's been performing, understand how they've been managing it. If they have expenses that are crazy, then it makes sense for whoever the GP is to be able to reduce those expenses. But if the GP is saying that I'm going to be able to cut OPEX by 50%, and then you look at the P&L and the expenses, you're like, where are you cutting this money from? Like there's nothing to cut. They're already running super lean. Then that's obviously a red flag. Look at their income side, make sure that makes sense. A lot of times, especially with self-storage, there will be things like U-Haul in the P&L. Mm-hmm. And I personally, as an owner, do not want to have U-Haul in the picture because it's just a headache. And so you got to make sure, like, is this proportion of the revenue going to be there when you purchase the property, or you're going to continue along with the U-Haul income? Make sure that the rents look right. They're in line with the market rents of the area. And then all the ancillary things, like even retail. A lot of self-storage facilities have retail shops in them where you can buy packing supplies and stuff. I don't like that. I like to shut that down for my facilities. So I underwrite them understanding that is not going to be a revenue item. So you just want to make sure that. So again, the GP probably wasn't going to give you this much information. They're just going to give you the high level. But this is what I would do if I were going through and underwriting it myself.
That's a lot of great info. That's really over and beyond. I hope everybody was taking notes there if they're interested in investing passively in self-storage. Before we jump into how people can learn more about you, get in touch, tell us a little bit about what you're currently working on.
Yeah. So we just bought a facility in Indianapolis that we're super excited about. It's got about 20,000 square feet net rentable on the parcel now, but we're going to build an additional 40. So that's exciting. We're under contract to buy one out in Texas. That's super exciting. And yeah, we're just going guns a-blazing, going forward, looking for good self-storage deals. I mentioned I haven't bought one yet, but I've been looking at industrial. I do want to put my eyes on industrial eventually. So I've been trying to understand how the underwriting works there and what to look for. And I've even marketed. We've had a few under contract that didn't actually close, but yeah. So self-storage, we're keep going that direction, and then looking at industrial, and it's moving forward.
Are you factoring in business-friendly states versus non-business friendly states? COVID sort of, I wouldn't say it, I'd say it exposed what was already there, but not as known about, which there are business-friendly states and there are non-business friendly states. And I know Texas is a very business-friendly state. Do you factor that into anything you look at?
Yes, but not super highly. Like if I found something in California or New York, and it was a great deal and it was in a great metro and everything looked right, but it's in a state or Illinois or something like that, it's in a state that isn't business friendly, I'm not going to not do the deal. I just go into it understanding that. But I don't market to those areas, so I don't generally see those deals.
Sure. Gotcha. As long as the numbers make sense. For those listening who want to learn more about you, learn more about your deals, learn more about self-storage, how can they get in touch and find you?
Best place is the podcast, the realestateinvestingclub.com. It's a long name, but it's if you just type it in there, it'll be there. And yeah, that's it. If you guys can hop on there, we actually on the podcast, we go over every type of asset. We don't specify, specifically self-storage or mobile home parks or something like that. We have people, had guys who flip farms. I've had guys who, do short-term rentals, whatever it is, we've had them on. So that's the podcast. You can find me there. And that's it.
Good stuff, man. So you heard it. If you're interested in learning more about commercial and self-storage, reaching out to Gabe to potentially do some deals, go to his website, therealestateinvestingclub.com. Did I get that right?
Yep. Whole thing spelled out.
Right on, man. Well, Gabe, it was a pleasure having you on. I'll have to circle back with you maybe next year. I'm very curious to see how your current deals you're working on end up working out. So we'll have to do a follow-up episode.
Sounds good.
Thanks, man.
All right. Thank you, Brandon.